Good morning and welcome. We're so happy to have you join us as part of our monthly Learn and Grow series, our monthly webinars. Today is part 2 of our Basics of Social Security and Retirement Taxes with Ken Sokol. My name is Sarah Diamond and I'm the Director of Legacy Giving with the Kansas Area United Methodist Foundation. I'd like to go ahead and introduce our staff today. We have our Director of Finance, Gloria Marcus, Joanna Trapp, our Communications Associate, and our President and CEO, Dustin Petz. And now I'd like to turn it over to Dustin to introduce our speaker and offer a word of prayer. Dustin?
Thank you so much for being here today. We're grateful for your presence and the opportunity to share this part 2 of the presentations from Ken Sokol. He has an MBA and completed a financial planning course of study at UMKC, and Ken's written weekly retirement investment newsletters for multiple years. He had previously worked with Hallmark Cards as a senior industrial engineer, and then has been doing a significant amount of work related to financial planning and taxes and in service of Social Security and other purposes. He's written several white papers and a few booklets as a consultant for insurance companies, and he currently serves on a Washington, D.C. task force for the National Academy of Social Insurance, addressing various aspects of Social Security. Ken, we're super excited that you're here and able to present again this part 2. And let me offer a prayer as we begin, and then we'll invite you to lead us. Let us pray. Gracious God, we give you thanks for this beautiful day where we can gather together in this season of resurrection. Remind us that you are with us and that you will not leave us nor forsake us, and that you'll help us to make the best of all of our days. Gracious God, as we learn today about a little bit more about Social Security and about taxes in retirement, help us to see ways that we can maximize the resources that we have and how we might use them to make a difference for your kingdom, as you have gifted us and called us to be about changing lives and making disciples, making a difference in our world in our unique ways all across this region. We ask and pray your blessing upon Ken as he presents, and us as we learn and discern how we might respond. God, we give you thanks. It's in Jesus' name we pray. Amen. Welcome, Ken.
Thank you. Just to remind people, I do not work for the IRS. I did back actually when I was in college. I worked for the IRS, but no longer. I know some people in Social Security, but do not work for them. Maybe some of my work, we make recommendations to them as what they might change to improve the program. Okay, moving on. As you've seen, we've gone through the basics of Social Security, but taking that basic information and say, well, how do I play out to maximize my benefit, not, so that help me in my retirement. So Social Security, the calculations and getting there, that's fairly complicated. And then there's all these rules and regs about who can take what and when, and how does one affect the other. It's very complicated. Later on, we're going to be talking about taxes in Social Security. Taxes by themselves are so complicated and dynamic. They change the way we do things from every few years. So I guess I want to apologize for the technical detail, but just ask questions as pass those on, as we'll try to address those as how they may be affect you. In looking at your personal Social Security and trying to make the best decisions for you and your spouse, here are the primary factors, and there are many, but financial need is one aspect as to when I might want to take benefits. you don't necessarily need, you could still be doing your, working in your career and take benefits. My sister-in-law was still employed at the local hospital here, but when she reached her full retirement age, she was able to pick up benefits from her ex-spouse in addition to her work income. So financial need is one aspect that needs to be considered. Probably the most important is life expectancies for you and your spouse. And if you were, the case studies we'll look at, I'll play a little bit with the life expectancies, but that's probably the most important factor in making a decision. Then also your other financial resources. Social Security puts on a slideshow that says that Social Security was never meant to be your primary source for retirement. It was just a fail-safe to provide a starting point. But for many people, I think the statistics are that over 60% of the population, retirement population, Social Security is their primary source of retirement funds. And as I'll may talk about later, I was fortunate enough to have a company that did provide a pension, a profit sharing. We had options for a thrift plan. When I was looking at retirement, I was looking at 7 to 8 different resources, from traditional IRAs, from a 403 with my wife, my Roth, her Roth, Social Security for her, myself, 8 different resources. And how do you juggle all those things? But that's definitely another factor. Working past the start of some benefits. As I mentioned, my sister-in-law was drawing Social Security while she was continuing to work. There is currently some considerations, because if you have a significant amount of income prior to your full retirement age, Social Security will reduce your benefit, and you will have the adjustment made to Social Security to account for that, and it takes about 8 years to get that money back if you happen to have given it up. The last is tax implications. As you're going to see, adjusting your sources of income and where you're pulling from different pools, there are a number of tax implications. It's changed the profile, and I'll show you that in some graphs a little bit later. As I mentioned, it's complicated. When I first started putting some of these things together for a program, the permutations are astounding. No two people, particularly a couple, is going to look exactly the same as another couple. They may have worked side by side, but lots of different factors are going to come into play. And so everybody has to look at theirs individually. You can't, I try to provide some cases that might come close to your situation, but it won't be exactly the same. But an individual can start anywhere from age 62 to each and every month, all the way up to age 70. So there's 96 months of options for you as an individual. You're married, your spouse is going to have 96 options for themselves. And 96 times 96, we're already up to 10,000 permutations. Your life expectancy, you can put in any month between age 62 and 120. Life expectancy tables in the last year or two by the government, the IRS, Social Security, they moved their life expectancy tables up to 120. I don't know that many of us will get there, but children, grandchildren probably will. Social Security benefits are based upon your income from just a few $100s per year, now up to $142,800, and anywhere in between. 35 years or more goes into the calculations. Your numbers can be, wide varieties for everybody. COLAs, we make several projections in the programs. Some people say, well, let's not adjust the COLA just to be conservative. Others want to put it in, look at present value calculations. The number of permutations, when you look at all these different options, are into the trillions. There's the trillions are many more times the number of people in the country. So again, it's a very personal situation, and your numbers are going to be somewhat different than everybody else's. So we try to boil it down. The case studies that we're going to look at, we look at a 3x3 matrix to give people the ranges or the extremes. So age 62 is one criteria, age 70 is the other, and in the middle, your full retirement age, be it 66 up to 67. And using those at 3x3 matrix, that's at least 9 different variations. And sometimes there's a couple more within that. The program we have may generate for some persons 9, sometimes it's 12 with certain things going on. If they've passed up age 62, then your options are cut down a little bit and to fewer outputs. So that being said, let's take a look at one. But this is a couple. We'll say it's John and Mary. Their age difference is about 3 years, which is statistically the average in the United States. I put in a PIA, which is the primary insurance amount for John of $2,500, and Mary has a benefit of $1,700 projected benefit. So putting that into the program, and you can see that we used 1.7% for COLA. The average COLA projected by the Social Security Administration is 2.8%. 1.7 is a 10-year rolling average. Social Security has been slow to change. They look at a long-term history for projection into the future. Yet when we look at only the last 10 years, it's averaged 1.7%. And if you talk to a number of economists in the country, they don't feel that the 2.8% that SSA uses is going to come about. So anyway, this program is putting the 9 different scenarios that it came up with. It puts them in order from the highest cash flow down to the lowest. Without looking at the details, based upon their life expectancy, the difference between the high and the low is $190,000 over the lifetime of this couple. Because of the age difference and the life expectancies, Mary is going to live 3 years older than John, plus she's 3 years younger. So that makes her living 6 years past John. So an important part of taking benefits is to say, even when John passes away with his higher benefit, Mary's going to be living off of that for 6 years after he expires. So this first scenario says John's going to wait till age 70 to file. Well, Mary will file at full retirement age. She's not going to receive any spousal benefits. The spousal benefit could potentially be only $1,250 for her while she's receiving her own benefits. Her income, her benefit is $1,700, so she would not receive any spousal benefit from John. Now, when John passes away, her benefit goes away basically, and she's going to pick up that $2,500 a month adjusted for COLAs as her survivor's benefit when John expires. The second scenario is, again, John starting at 70 and Mary files at age 62. It goes down. I'll drop down to the bottom of the page. The worst case scenario for them is that if they both take benefits at age 62. What this program doesn't look at, doesn't have the ability to say, well, what other benefits might they have? What might their full retirement look like? For a couple to be able to do this and say, well, gee, I may retire at 62, but you're telling me I should delay my benefit until age 70. I'm going to give up 8 years of Social Security benefits to max out. I have to have another source of income if I want to walk at 62, and if I'm going to delay my retirement until age 70. So whether I'm living off of 403s, a pension, IRAs, whatever, you have to figure out, sitting with a financial planner or somebody else, to say, can I get from age 62 to 70 off of my other retirement resources to start my benefit at age 70? Realize again what we saw in the previous presentations. If you start at 62, for this couple, they're going to have a reduction of benefits at 8% a year, so that about a 40% reduction if they start at 62, or a 32% increase if they wait till age 70. This takes all of this into account. This particular program, which we don't have time for, actually generates a cash flow chart for their lifetimes. So showing the income, and you could look at one page versus another, realizing that, how do I have the resources to get to age 70 without Social Security? And then if I start it, Social Security will actually pay out more money if looks like John waits to 70 and Mary takes her benefits somewhere. She could almost take it anywhere with a minimal offset. But when John takes his benefits at age 62, what that means is that when he expires, that benefit that his wife receives for her lifetime will probably be, much less than what it would have been. And so if John takes into account, or this couple takes into account, Mary's benefit for 6 years after John expires, the impact of Mary will be significant. Matter of fact, in looking at this scenario without the details, I would probably say that her survivor's benefits received from John would probably be less than her $1,700, and that she would take no survivor's benefits and just have to live on her own with a reduction of what, a third less than what John was making. So anyway, let's go to look at the second scenario, and we changed things a little bit. In this scenario, I took Mary's income down to Social Security benefit down to zero. The requirements again for Social Security, you have to have 40 credits to qualify. You can receive 4 credits per year with an income of $1,500, $1,600. So you would have to have a minimum of 10 years with 4 credits, or spread those 40 credits over your lifetime. But in this case, Mary did not qualify. So this case, she's going to receive a spousal benefit depending on when John starts and when she starts, that's equal to half of what his primary insurance amount is. So the outputs of this program are somewhat limited. Primarily, there are no delayed retirement credits for spousal benefits. So that takes out several of the scenarios that might have occurred with Mary in the previous chart, where she had her own personal benefit at age 62 with delayed retirement credit options, et cetera. Anyway, the difference again from the best case scenario to the worst case scenario is still about $200,000 over their lifetime. We've got the same life expectancy scenarios. So Mary's going to be living off of John's benefit after John passes on. So anyway, John files at 70. Mary again files at full retirement. She'll have no reduction in her spousal benefits because of that. And their income is just a little bit less than what it was in the previous slide. But still, the difference between the best scenario and the worst case scenario is $200,000 for their lifetime. So again, they got to have the financial resources if they want to retire early, draw down on other sources of income so that they can start benefits at age 70. If you play this out, truthfully, you're actually in a better financial situation having spent down your IRAs and started Social Security later. You will end up paying less money in taxes in all future years because of the higher Social Security and the lower taxable income. But anyway, that's looking at the much bigger picture. You have to find somebody in financial planning that understands all of this stuff, the taxes and distributions, et cetera, not just investing your money. Let's go on to the next slide. This scenario is their birthdays are the same. I reduced the life expectancy of Mary down to 82. I don't know that made a significant difference. The difference here between the high and the low is minimized. It's down to, what is this, $130,000. That's primarily that way because of Mary's higher income. In other words, there's not going to be any survivor's benefits to one or the other, more than likely. There could very well be if Mary, for instance, if Mary took her benefit very early, maybe her benefit would be reduced to $1,600 a month. John delayed his benefit to age 70. His benefit would go up to $3,300 a month. In that case, Mary would have a survivor's benefit because John's benefit would be what she would receive rather than hers at a loose. So, but the fact if they're looking at taking it at the same age, there would be no survivor's benefits. But anyway, both individuals delayed to age 70. Their life expectancies are right at the break-even point. So that's the break-even point is where it doesn't make any difference. It starts saying that, well, if you're going to live past the break point, you want to delay your money. If you retire early, if your life expectancy is below the break point, you want to take your money early. But anyway, this scenario is that they have similar incomes and similar life expectancies. The difference between the high and low is minimized, but it's still $100,000 over their lifetime. Let's go on to the next one. This one again is Mary without any doesn't qualify for Social Security benefits on her own merit. But I also changed the birth age so that they have the same birth date. Mary is the same age; she's not 3 years younger, and because of that shift, the options are minimized. And so here's only 4 scenarios with only the difference of $100,000 between them, because there's, like I said, there's not a lot of difference. John files here at full retirement age. Mary delays her benefits down to the age 62. Because these individuals are living up to the break-even point of 82, it's showing almost in every scenario that the worst case is if they both start at age 62. That's not saying they can't retire, but if they retire, they live off of something other than Social Security if they want to delay it and maximize Social Security benefits. Let's go on to the next one. Let's see, what do we change here? I changed the life expectancies. Here I said that John is only expected because maybe some, hereditary disease. It could be hearts or cancers, predominance, whatever. My brother-in-law has a hereditary cancer, and it's affected aunts, uncles, mostly on the male side, but aunt, uncles, grandfathers, parents, cousins, and but through numerous surgeries and lots of chemo, etc. He didn't expect. He's the same age as I am. He said, if I'd known I was going to live this long, I would have done things differently. But he said, looking at my family history, I didn't think I would get old, ever reach 70. And he's lived well past that. And so who knows how long they're going to live. At any rate, we look at this and it still comes out that John retiring at or taking Social Security benefits at age 70. And truthfully, it's not for himself, because he's going to be feeling cheated, because he didn't he only receives benefits for maybe 5 years. Whereas, Mary has got the same life expectancy here of 85. She's 3 years younger. Mary is going to live 10, 13 years. She'll be 13 years older than the age that John passed on. But she's going to be living in many scenarios off of his benefit in those retirement years. So he's delaying to age 70, not for his benefit, but for the benefit of his wife. And so this age 70 and 62 plays out as being the best. The worst case scenario is age 62 and Mary trying to delay to age 70. And the first thoughts, Mary would think, well, gee, I'm going to live a lot longer, so I'll delay my benefit. And John's looking at it and says, why, my life expectancy is short, so I want to take it early. That first thought of what they should do is exactly opposite what would benefit them as a couple. And so when we look at individuals, the first expectation is correct. I'm not going to live very long. I want to take it early. But when a couple is looking at their numbers together and the wife has got a long life expectancy, John would be, in this case, would be shortchanging his wife in retirement benefits if he were to take it early. So you notice that the numbers are a little bit larger because of this. We're looking at what, $240,000 difference between the best case scenario and the worst case scenario, which is very opposite of what it would be for individuals looking at their best option. it's just interesting. This one, I pulled Mary's life expectancy down several years, down to age 78. The same scenarios. This is more typical of what we see. John starts at 70, Mary starts at 62. In other words, the higher, the individual with the higher benefit starts later to maximize that. The person with the lower benefit starts early, and the worst case scenario is 62 and 70 just flipped around. Because Mary's got a fairly good benefit, but the shorter life expectancy, you see the numbers are down significantly, with only $120,000 difference over their short lifetimes as being not as great as if somebody were going to live. Statistics, I might mention that the statistics that they're looking at right now are saying that anyone at age 65, if a couple reaches age 65, there's a 50% chance that one of them will live into their 90s. So you stop and think about that. Life expectancy programs used to be fairly common on the internet and free. Today they are not. When they were available, I did the individual life expectancies for both myself and my wife, and both of us came out 90 plus. The life expectancy tables by the IRS and Social Security have been extended to 120. That's probably more for our children and grandchildren than it is for us, but many of the boomers, this suggests that many of the boomers are going to live into their 90s easily. And one of the fears of many individuals, along with their financial planners, is that they're going to outlive their benefit stream. But with Social Security, that's not going to run out. Well, maybe not. We're still trying to make sure that the trust fund doesn't become depleted in 2034, but I would expect that the government will change that so that we're receiving full benefits. The other thing I might say is that in lecturing around the country and talking to a wide variety of people, and primarily in financial planning, is that we think that the baby boomers are going to outlive their life expectancy as calculated from historical data. Personally, I know that I don't think I'm going to die from what my parents died from. I know what their problems were medically, et cetera, and I'm doing things about that so that will not occur. I think in talking to a wide variety of people, the baby boomers are going to blow away the life expectancy tables that exist right now for them. Particularly for many of us that have worked for companies where we provided medical insurance, so those of us that have lived a life with education and financial resources to have addressed medical issues and problems, again, I think we're going to blow away the life expectancy tables. Okay, next slide. Okay. I hopefully with the 6 or so scenarios that one of those might say, well, that might be similar to what I'm going to see for myself and my spouse. And I mentioned to Sarah that through the foundation, I'll be willing to generate a printout of the information that you just saw for any individuals that they want to provide me the detail. I'll make that available to anybody. This is now we're going to transition from now that I'm getting these benefits and moving into retirement. there are ways to optimize your net income. This is not a way to cheat on your taxes, but this is to avoid taxes. And most financial planners are currently not addressing this for their clients because taxes, again, are more and more complicated. They haven't been simplified by recent changes, but you can still, with knowledge of how they're working, you can optimize your income. This is a textbook introduction to taxes if you take a tax course. And really it hasn't, this part hasn't changed. The details are more complicated, but basically we take all income. There's adjustments that are allowed to that income for various things, for moving, for contributing to an IRA, et cetera. And you'll get down to an adjusted gross income. Then you typically take deductions and exemptions, reduce that adjusted gross income to taxable income. You go to the tax tables and you look up the taxes that would apply to that income. And then there are some credits that can be primarily taken to reduce that. It can be from child care. It could be from just a child tax credit. It could be educational for your children or yourself, lifetime learning credits, et cetera. That'll adjust your tax, and then then comes down to a refund or the amount that you owe. I have a copy of my tax return from my parents from 1950 or 51. It was a half a sheet of paper, half of an 8.5 by 11, half of that on one side. That was the whole tax return to what we have today. It's so taxes are again very complicated. I do taxes with AARP. I would have to say that 95 to 98% of the people coming in have no clue as to what where they're going to be, whether they're going to get a refund or whether they're going to have to owe. And the only thing they're comparing it to is, well, this is what happened last year, and it's going to be similar this year, hopefully. Okay, let's move on. This is for graphic purposes, this is another way to look at taxes. This is based upon the 2021 tax structure. And there have been was a number of changes made. This is about 3 years ago, reducing some of these levels. But considering that, and we don't have exemptions anymore, you got a large standard deduction, and you still have child tax credits. But this is for primarily for a couple over 65. There's a couple credits that you get for that. But up to about $27,000, you pay no income tax. So you can see this chart comes over to below 30 before it jumps up. And then you go into a 10% tax bracket for a little while. Your income gets up. This is your taxable income, or in this chart, it's actually gross income. Your gross income gets up to close to $50,000, and you'll jump up to a 12% bracket. It used to be 15, and that 12% bracket goes for an extended period of time until your income's over $100,000, when it jumps up to 22%. It used to be 25. And then that goes on to well over $150,000, $160,000. So if you were to just to say, well, my gross income, adjusted gross income is going to be $80,000, you come up to this chart and say that you're in the 12% bracket. What that means is that of the next dollar that comes in, 12% will go to taxes. If you were to say at that point, let's say I'm again at $70,000, you look at the dashed line, you drop down, you're actually paying on your total income, only 7% of your total income is being taxed. And that's because the first 27 was zero. And so the dashed line is the average tax that you're paying based upon that income. The solid line is what we call the marginal tax bracket, the next dollar that I have. If I were looking at this chart, I'd say, well, gee, for me, I'm going to be in the 12% bracket. And you look at that and say, well, gee, when I get up to about 108,000, that jumps up to 22%. I want to avoid that. And are there ways to avoid that so that I don't jump up into that higher bracket? And that yes, there are, but they all take planning. But what's happened with Social Security is that in 1983, President Reagan and members in Congress and government agencies, the IRS, Social Security, they saw that the trust fund was going to be depleted because of lack of funding. So under President Reagan, they made potentially part of your Social Security become taxable. 10 years later, 1984, under President Clinton, they were again looking at those numbers and said, you know what, this is still projecting a deficit. So they put in a second tier to tax even more of Social Security benefits based upon income. And that changed the whole profile of what this graph would look like if you were on Social Security. So let's take a look at it. Oh, yeah, here's what I'm just commenting about. It was 1993 with President Reagan, and then again under Clinton. The next page, I think, is talked about Clinton. Yes, 1993 Clinton. So it was a bipartisan. So the Republican president started this, and President Clinton increased it. And so many people have problems. Wait a minute, this is money that's already been taxed that I'm receiving, and I have to pay tax again. And the answer is, I'm sorry, yes, you do. The proceeds from this tax, all of it goes back into either Social Security or into the Medicare trust funds to help extend the life of those policies and keep it fully funded. So the government's not getting it to spend, they're getting it and it's going into the trust funds. Next page. Here's a basic calculations of what's going on. These calculations are complicated. Actually, at one time, there is a form in the tax package you pick up in the booklet. The page that had the most errors, causing up to several $1 million of time and effort to fix it, was filling out the page that calculate what if any of your Social Security was taxable, because of the complexity in the calculations. And if you're familiar with the form, it says, if this number is above this, then do this. If it's below this, then do this. Jump to 5, skip 3, and it's crazy. Thank goodness for computers that do all this stuff for us, because, like I said, it was the one page that had the greatest number of errors, and when somebody was doing a paper return. Let's go to the next page. Here is an example. Mr. and Mrs. King have a taxable income of $42,000 and a Social Security totaling $30,000. And in their other income, they had $2,000 in tax exempt money. So the calculations are, you take your taxable income plus your tax exempt money plus half of your Social Security, and it's equal to the thing that they called provisional income. Provisional income was $59,000. They used that to try to determine what portion is taxable. Here I look at the second threshold first. They say, well, gee, you're $15,000 above that threshold. That means that 85% of that 15,000 is taxable. And then there's another 12,000 because it was over the lower threshold is taxable at 50%. And so this couple will have 18,750 of their Social Security is going to be added to their taxable income, become part of their adjusted gross income that goes into before you look at exemptions and deductions. This is a very simple example, and but again, the calculations that go through this are many people stumble over them if they have to do it manually. Go to the next page. So this is what happens when this is with $40,000 of Social Security income. I would expect that many people, and I myself included, my Social Security with my wife's benefit and my benefit later this year when she turns on her benefit will exceed $40,000 a year. Projections now, if a couple has maxed out their benefit because of their income over their lifetime, they could actually go upwards of $60,000 a year. So, and delaying it to 70 even increases that. So Social Security benefits are going to be a significant portion of, I think, of everyone's life in retirement. All right, what happens to taxes? Well, if their taxable income compared, in addition to their Social Security income, they don't get taxed on anything until it goes over about $63,000. Whereas without Social Security, they jumped up into the 10% tax bracket at $27,000. Here, with a significant portion of their income coming from Social Security, they're not paying taxes on anything until over $60,000. And look at where it jumped up to a 15% tax bracket, that little small first step there. It skipped right over the 10%. Well, actually, what that is, it's the 10% plus 50% of their Social Security. So a 50% increase in 10% is 15%. So this is creating artificial thresholds or brackets that are just very confusing. Look at and that goes up to looks like a 20% bracket. It's actually the second step. That's really an 18% bracket. That's 12% increase by 50%. So it's very convoluted. I developed this graph 13 years ago. And believe it or not, there are some financial planning companies that are using this bracket to help determine how much should come out of my taxable pool of money versus my non-taxable pool. So anyway, what happens is after this goes up to 20-some%, it drops back down to the 12% bracket right there. You've got it. And what's happened there is at that point in time, 85% of their Social Security has become taxable, and that won't happen anymore. That once it hits that max, it's done, and this is returning to the normal profile, offset a little bit. The other thing that's in this chart is the blue dash line and the red dash line. What it shows was that at no point in time will the individual pay more in taxes than they would with Social Security. So Social Security, the dashed red line, is never equal to or goes above the blue line. So with Social Security, they're never going to pay as much as they did without Social Security at that same level of income. I have to mention that I tried to pass this thing on to a number of financial advisors through my consulting, and a lot of them just shaking their heads and trying to understand this. I've had some people look at it that one agency had morphed from an income tax preparer to financial planning. They saw this and they knew exactly what it was saying from the get-go. But from a number of people, the agency that I consult with, they looked at it and they said they had more questions than answers. They had difficulty understanding it. I use this personally every year for looking at my taxes. I'll have to mention that this structure changes with the amount of Social Security. So any couple with $40,000 of Social Security, any income level, this chart is correct. But if their Social Security is $30,000, the red line starts shifting and moving around, or $50,000 or $60,000. So you have to know the level of Social Security income to be able to look at this graph and have it meaningful. Before we go off of this, there's one couple things that don't show up on here. That's not part of the calculations. At the bottom, it says total income without qualified Roth IRA distributions. Your Roth IRA income is not on this chart. It does not have an impact on your Social Security, etc. So if I wanted to have, let's say that I wanted to have $90,000 in income and I didn't want to pay any taxes. What that means is I'd have to take my Social Security and taxable income would have to be $63,000, and then I would have to have Roth IRA distributions or non-taxable money to take me up to that level. I'd have to have $27,000 in non-taxable money, such as an IRA, or it could be a thing called QCDs, which you may have heard of. Hopefully you have through your churches. Qualified charitable distributions do not go on this chart either. So using Roth IRAs and qualified charitable distributions, I could get up to 90 or higher income, but still my tax structure is based upon $63,000 and I would pay no federal income tax. Interesting thoughts, and we'll have more examples of this down the road. Let's go to the next slide. Unfortunately, for an individual, it's much easier for an individual to have income taxes that jump up like this. A couple married filing joint, if their Social Security gets upwards of $50,000 or more, their tax structure would look like this. I think it was in 2003 that Scott Burns, a financial writer for the Dallas Sun newspaper, called this the tax torpedo. That some people would get into this bracket of income, single people, and they'd see this jump up, and they were paying a marginal income tax for that period of time of over 40,000 or 40%. That meant that any additional dollar while you're in that bracket, 40% of it goes to pay taxes. That's federal taxes. At one time, it could be in as state taxes added another 9% for this, so that they were paying over 50% on the next additional dollar coming in. And boy, I have this chart. I had a client that was in this bracket. I was doing her taxes from one year to the next, and she was in this bracket. And I looked at her two returns from the prior year and the current year, and I couldn't explain it to her. I said, "I'm sorry, I must have made a mistake. I'm going to call you back tomorrow." I went home and did her taxes manually several times to try to understand what was happening. I didn't have a chart like this in front of me. That led to me developing this chart. That led me into doing a number of things with Social Security. But anyway, it can happen. If a couple today had both individuals fairly high up in the Social Security benefits to where they were $50,000 to $60,000, a married filing couple would see this same chart. And it's one you want to avoid. If you get through it, then you go back past down to the normal tax structures because 85% you've maxed out your taxes on Social Security, so you defer back to a normal profile. Notice again the dashed lines, the blue line and the red line. At no point in time did they pay more in taxes with the Social Security than they would have without. So it's a short-term blip. This profile changes based upon the income of the individual in Social Security. So you can't say, well, if your Social Security was $20,000, you can't use this chart. If your Social Security was $40,000, you can't use this chart because the brackets shift dramatically based upon your Social Security income. Anyway, Scott Burns called it the tax torpedo, and it caught me with a client, and I couldn't explain it. That was 14 years ago, 15 years ago. All right, let's go on to the next slide. So the question is, how well can you juggle, and do you have the things to juggle? In budgeting for myself, I try to budget a year and say, here are my needs and wants, and I'd like to achieve this level of income. And then I look at the many pools that I have, and again, I had all of these. I was fortunate enough to work for a company that had benefits. I tended to be a saver with my wife. Most of that, the dramatic changes came when the kids got out of college empty, and we were empty nested, and we were able to contribute significantly to all of these. So Roth IRAs, qualified age 59 and a half, 5 years into the program. They're qualified distributions. They're totally tax-free. Social Security, if you maximize, you have the options to take it at 62 up to 70. That can be all over the board. Savings, moving around clockwise, savings and investments. Once you max out your money going into your pensions or IRAs, et cetera, I had significant savings outside of my IRAs. It's interesting. So when I cashed in $1,000 in stocks, well, I only had to pay tax on the capital gains, and that's usually at a lower tax level than long-term. It's a lower tax bracket than what you would normally be in. Pensions and annuities. Again, I work for a company. I had a pension in addition to profit sharing and thrift plan, et cetera. Some people purchase annuities, and there's all kinds of pros and cons out there on pensions and annuities. The benefit is that they're typically guaranteed for life, and oftentimes with rights of survivorship, so that your spouse can actually pick up that pension. So that's an option. Traditional IRAs and 401ks. My wife's was a 403b. So here I'm showing 5 different resources, but again, I had 2 Roth IRAs, one for me and my wife. Traditional, I had one for myself and my wife. Social Security. So I had several buckets or several legs to stand on, and different pools to pull from. And I began early on and moving money from traditional to Roth, just to build that resource up, knowing that it's the tax benefits there. Delaying till my wife will be 70 later this year, and she's going to turn on her Social Security, maximizing her benefit there. So some people don't have these resources. Many people do not have these resources. I was fortunate enough to have these, and so I retired some 20 years ago. Having these options gives you the ability to reduce your taxes, as you'll see in the next few slides. So here I try to figure out how to present this to make it more meaningful and to demonstrate what can be done. So here I said, okay, let's say that I want to achieve $100,000 in income. 20, 30 years ago, that would have been a lot of money. Now with a couple and both of us working, $100,000 income is getting more to the average of a couple with both members working. So anyway, I picked $100,000. We'll see what happens. So here, this is all based upon 2021 taxes. I have to stop and think whether I think I made them both 65. And again, I do taxes with AARP, so I've got access to tax programs to play with these numbers, et cetera. I have my own spreadsheets that do some of these calculations. So let's walk on down. All of it coming from a taxable source, whether it's wages or IRAs, et cetera. I'm going to end up paying $8,266 in federal tax. Well, let's say, well, I'm going to retire and I'm going to get $40,000 from Social Security and reduce my taxable income to 60. What happens? Well, I'm going to save a little bit of money, I mean $700 if that happens. Interestingly enough, I'm over all of the thresholds. So in this situation, 85% of that Social Security is going to become taxable. So there's only 15% of my Social Security that escape taxes to lower that number. So let's go to the next page. All right, now I'm going to enter in and say, well, gee, what if maybe I tithe and I do QCDs, qualified charitable distributions. They come out before the tax calculations, before the calculations on Social Security. That could be a Roth IRA income. That could be an annuity income from after-tax money that established an annuity. So there are different resources. It cannot be municipal bonds. Municipal bonds go back into the calculation for tax on Social Security. So that non-taxable is not municipal bonds. It's QCDs, Roth IRAs, or a non-taxable annuity income. But let's say that $10,000, I tithe 10%, and that went to the church. I reduced, if we look at that number on the last page, that's $7,500. We've reduced that down $1,900. So I contributed $10,000 and I got $2,000 back as a result of that. Oh, $1,900, almost $2,000. That's good to know. It's interesting if you happened to be in that. What if I was in that big bracket of taxes, marginal taxes, where it jumped up to 40-some%? If you were an individual in that specific situation and contributed $1,000, you'd get over $400 back if you're in that particular bracket. So there's so many factors to consider. Hopefully something here will be meaningful. Well, let's move on down. I'm still shooting for a $100,000 gross income. I've still got the $40,000 in Social Security. I now reduced my taxable down to $40,000, and my non-taxable, I moved it up to $20,000. Again, that could be QCDs, Roth IRA, et cetera. I now have knocked down my taxes another $2,200. Remember, I started off $8,000 plus, and now I'm down to $3,000 plus. I've saved almost $5,000 by generating that non-taxable income. And again, that could be QCDs, non-taxable annuities, Roth IRA, et cetera. the next slide, or not the next slide, but the next box down, I now move my taxable down to $30,000 with $30,000 in non-taxable income. As I mentioned, I was fortunate enough that when Roth IRAs came out, I understood the impact that they were going to have, and that was in 1996. So I've been working these numbers for over 20 years, and my non-taxable retirement money is greater in Roth IRAs than my taxable portion. So, and over a long period of time, you could fund those and have the ability to move money around to say, how much tax do I want to pay? And so I look at these numbers every year. I'm a nerd in that respect. So anyway, the bottom line, I've got $30,000 in non-taxable, $30,000 in taxable, and my $40,000 in Social Security, and I'm down to $1,300 in tax. I've saved over $7,000. 7,000 out of the 30. That's about 25% reduction of return on the non-taxable money. Let's go to the next page. Just to make this extreme, I started working it down just to show what would have to happen to move this down to zero. And here we are with the same Social Security income of $40,000, taxable income of $20,000, non-taxable money at $40,000. That's a stretch to get there, both of these. But here's an example where I moved it down to zero. And I can tell you that this works. It does work. But that non-taxable can be charitable gifts. It can be your, like I said, QCDs, can be some annuity income if it's tax-free, and Roth IRAs. And it can happen. I'm not cheating on taxes by doing this. I am just changing my allocation and using money that has been taxed before. My Roth IRA money income to that fund was all previously taxed. So this is tax avoidance, knowing and understanding how to make it work. Let's go to the next slide. I'll open it up for questions. As I mentioned earlier, through the foundation, if you were to provide your expectations on your benefit and Social Security, your birthday and life expectancy, I will generate those, like you saw in those case studies, the output of the program. It's a program that I wrote and sold several years ago to an insurance company back east. And I'm still being paid by them to maintain the program. It'll come with some distribution pages of cash flows, et cetera, for your benefit. So I'll make that available to anybody if they want it. Do we have any questions?
Ken, this is Dustin. I have a question. And my question is about, so that last slide you showed $100,000 with 40 of it coming from non-taxable. But based on the charts, if a family simply had less than $63,000, some from taxable and some from their Social Security, they would also have a zero tax burden, right? Is that, if you're low enough in your revenue, you would meet that criteria?
Oh yeah, Dustin, you're right, and there's so many different permutations in this. That Social Security number changes, the chart starts to change. You could actually look at the first slide that had no Social Security on it at all. Say, well, what would I have to do there? If I had no Social Security, I'd have to have $73,000 in non-taxable income and I could get to the same zero level. I have to admit that pushing the numbers down to zero is probably not the optimum situation long term. In other words, what's going to happen if you've got an IRA out there? As you get older, you reach 90, your distributions are start out at 10, 15, 20, 30, 40% of that IRA has to come out. And so it almost becomes unsustainable, so that there has been very little work, and I know of no programs that are able to do this, to say, project out my RMDs till age 100 and try to figure out where the taxes are going to be. Very few programs are going to project taxes tomorrow, 5 years or 10 years. And there's just so many factors. It's very difficult. Short-term, long-term planning may be good for 5 years out. And beyond that, it's almost, we know taxes are going to go up to pay for everything that we've been enjoying in the past.
One of the clients that the foundation works with, a lay person in our churches, made a comment to me a few weeks ago about it might be advisable to take your Social Security at 62 or at some earlier age, maybe 65, and invest as long as you can beat the 8% return. So, I mean, that's maybe another strategy. I'm curious of your thoughts.
Actually, I've had that. I had a financial planner raise his hand and ask me that question during one of my presentations. I think it was out west. And the answer is, first off, you have to beat that. Secondly, the Social Security dollars are taxed at a lower rate. So, the other thing is, you have to add COLAs on top of that 8%, because your Social Security is going to receive a 2.8%. I'm saying 1.7, but let's say a 2 to 3% cost of living adjustment. Well, if you add the cost of living adjustment on top of the 8%, and I haven't considered the taxes yet, I have to beat more than that. I have to be 12% or greater on that investment return to beat it. And even then, I don't think you're taking everything into account. The Social Security is adjusted. It's got a cost of, it's got a survivor's benefit, et cetera. There's so many factors that go into that, I think the individual you're talking to has got the start of the concept of what has to be done, but it's not 8%. It's 8% plus the cost of living, plus the offset in taxes that are on Social Security. He's got the first component of it, but there's 2 or 3 others that, in addition to that. And who's going to come up and say, yes, I can guarantee a 12% return for the next 8 to 10 years? I don't think anybody's doing that.
Yeah.
We have a question that's come through into the chat box, and that is, what happens to my IRA at the time of my death, and can the foundation help me with that?
Well, the first part is, it used to be, we called it stretch IRAs and stretch Roth IRAs, to where I could pass on my IRA. And the old rule was that I had to do it based upon life expectancy. Well, now they've made it 10 years. So you have 10 years to fully distribute an inherited IRA. You can take it all in the first year, you could take it all in the 10th year, or you can take it equally across that period of time. But in 10 years, it has to be out. One of the options, QCDs, qualified charitable distributions. You can do up to $100,000 a year, and and handle it that way. So, if you wanted to take it out, pay taxes on it, and then distribute it, that's one way. But I really like QCDs. QCDs have changed a lot of things. Most of my charitable contributions now are QCDs. The one unfortunate thing, and I know there's people working on this legislatively, you cannot take a QCD and put it into a donor advised fund. I know the foundation has them. I have mine is through Fidelity. I cannot take my QCD distributions and put it into my donor advised fund. I'd love to be able to do that. But right now I can't. I've been involved. I've got an endowment fund that I've done at college. We're gonna do endowment funds within our church, and you can put a QCD into a public foundation, but you can't put it into your own donor advised fund. So that's the way I would handle it.
Likewise, let me just share, Ken, that that's one of the key ministries that we do with families is if they want to create a permanent endowment, that it can be the recipient of your IRA money.
Yep.
If you're wanting to give charitably through your estate planning and your estate money, the IRA tax deferred money is probably the best pool of money to give charitably if
Yep.
that's your desire. If you want to tithe on your estate or a child's worth or whatever it might be, and we can do that to support your church or other charitable causes beyond that. So we kind of work with families to do donor advised funds in life. And yes, you can't use your IRA to fund it. You could maybe use appreciated stock or an inheritance or some other kind of pool of money, and then use your IRA upon death to help bring funding for that. But I think you're exactly right, and there's tons of ways that I guess as I'm learning from you, Ken, it's how do I maximize my resources for income and to support the charitable causes that I care about. And so, you have to be 69 and a half, or excuse me, 70 and a half years of age to do the qualified charitable distribution.
Yes.
So if I'm 44, almost 45, so I can't do a QCD. My only option is, other kinds of pools of money. Maybe appreciated stock might be another option for me. But once I get to that 70 and a half years of age, I can start using the IRA accumulated resource to give charitably to fulfill my pledge or my tithe.
Yeah. My RMDs are already starting to cause me problems because it's more taxable money coming in. And I'm in a fortunate situation where I can give away almost all of my RMDs and to minimize my taxes, and it increases the money that I can contribute to the benefit of others. So it's great. Unfortunately, there's so many different options that the average individual needs help in trying to determine what they are and what fits their situation.
Ken, I remember you talking to me, it was a year ago, I think, that your intent of some of these things is to make the biggest impact in ministry and to be able to give charitably. And so are there other questions, or I'll kind of close this out? I think as we shared before, if you have questions, you're welcome to respond. We'll send you an email with the link and other materials. You can let us know. We'll help find ways to connect you to Ken. If there are ways that we at the foundation can serve you, we'd be honored to do so. Sarah, did you have other things?
Yeah, it looks like we just had another question come through into the chat box, and that is, can I make a QCD to a local church? And if the church were to make a decision to take it and create an endowment with it?
Absolutely.
Yep. So, and you can give up to $100,000 if you so desired in a year out of your IRA. I think, engaging them about doing that, and you could, help them start an endowment and then make contributions to it as you so desire in life. And then in your estate plan could further contribute.
Yeah. Let me since I do use QCDs and I do them almost monthly. I'll tell you some of the ways that I handle it. The QCD has to be go to a recognized charitable institution. There are some institutions that they may not be a 501c3, but if they are the beneficiary or the recipient of money coming from a charitable organization. For instance, I was volunteer in missions for several years. I've traveled extensively, ministries in Poland, ministries in Haiti, etc. They're not recognized by the U.S. government as a 501c3, but they are an institution that's supported by the church. So in almost all of my QCDs, I actually ask them to be sent to me. They're made out to my church or they're made out to another institution, and I can send them directly to the institution or I send them to myself. I have them sent to myself. The last QCD to the church, we created a COVID relief fund within the church. And so I had the QCD sent to me. I had half of it going to the general fund as part of my annual pledge. And I had the other half designated to go to this COVID fund. So the check is made out to the church, received by me, and then I put the notation on it as to how it's to be designated at the church. So it happens at that time. And had it gone directly to the church, I'm limited in the amount of information that I can put on the check. So I like to handle the check first, and that way I could direct it how it's to be spent, whether it's to go to Poland, to Haiti, some other ministry of the church that the government doesn't recognize.
I served as a pastor of a church, my previous role, and we would get checks from different financial institutions, but there wasn't the clarity. And so if you do a QCD, even if it's directly to your church, please communicate with them. Hey, expect some money coming from my IRA. This is what I want to be able to do with it. Or do like Ken said, and deliver it to you, and you can make those notations.
We're so incredibly grateful for you. We're so grateful for our participants. Ken, thank you so much for joining us today. Not only have you put together one webinar, but you put together 2 webinars for us. So it's been such a pleasure working with you, and I've really enjoyed it. So thank you so much for all of your hard work and time you've devoted over the last 2 months putting these presentations together for us. So I hope everyone has found this time valuable and helpful to you. And if you have any other questions or thoughts, please follow up with us. We'd be happy to address those and to serve you. And so again, thank you for joining us. I want to take a minute just to share with you about our next webinar that we have coming up. It's going to be on May 11th. It's also at 10 o'clock. And so it's going to be on how to talk to people about giving. And so that webinar will be led by Dustin Cooper with Horizon Stewardship. And more specifically, Dustin is going to talk about money and how it's hard for pastors to talk about money, the financial challenges facing the church today, and the 5 disciplines of financially thriving churches. So that's our next webinar coming up. If you're not already registered for that, I encourage you to sign up for that. You can find the registration link for that on our website, but we'll also send a registration link to that in our follow-up email too, so that you can have that handy. So watch for follow-up emails with that. We will also be sending out a recording for today's webinar. We've been recording that, so please watch for that, and also feel free to share that with other members of your church or colleagues that you think might benefit from that. So we always encourage that. And with that, thank you again for joining us, and we hope you have a great rest of your week.